Hello, thanks for joining this video. I'm going to talk through our example financial model. This is available to download on our website, and we wanted to give an example of what a financial model might look like for those who haven't used one before. However, this is just meant to be an example. It has not been audited and it can't be relied upon for financial advice. So yeah, just use it as an example. I wanted to do a bit of a guided tour of this model. So I'll actually start on the output sheet, which is where we want to end up. And this is really the purpose of the whole model, is to take the information you have and the assumptions and forecast forward a set of financial statements. And so these are the financial statements that we'll end up with at the end. And they have all of the key areas that you would expect to see in financial statements, such as revenue, cost of sales, and overhead costs, bringing you out at the net profit. The monthly cash flow sheet looks at everything on a monthly basis. And this is really important when it comes to cash flow to make sure that you are not going to run out of cash. Where we're going to spend most of our time is on the assumptions sheet, because this is the engine that drives the whole model. So in this, we want to start with general assumptions. You would need to put in your particular financial year start here. This is just an example one that we're using. And you might have your own figures that you use for inflation that you put in here. Just something to show you is we have this column here where if you are making an assumption, you might want to write down why you've chosen that particular assumption. So for price inflation, often people use the Bank of England base rate as a guide. And so you might want to write that in here. Now, revenue is the most complex part of the model to do. And we have put some example workings in. And you can see there's actually two different areas where you might want to input revenue. So we've got revenue stream 1 and revenue stream 2. This is where you want to do some analysis of your business before you even step into a financial model. And you should look for support either from your board or whoever helps you with your financials, or just talking it through out loud is always a good way to start, because each business will be different. And maybe one business has just one product and one set of customers, and so you can just use one revenue stream to model it. Other businesses will have, for example, a product that they sell and then training that they sell related to that product. And that might have drivers of growth that look very different. And so that's where you might use the two different revenue streams. When you come into modeling your revenue, you will also need to have a think about what is important in your business and what are your key drivers of growth. How do you think about growth and how do you think about customer acquisition? And in this particular model, it's driven by pipeline. So how many contracts are coming down the pipeline, and then what percentage of those contracts do we expect to win as a business? And that brings us to a number of customers. And so these pipeline assumptions would likely be based on either historical figures, or maybe there's some market analysis that you've carried out and you know that there's some new contracts going to come onto the market. Conversion rates, again, are these going to be based on your historical figures, or are you forecasting a change to your business that will allow you to increase those conversion rates? Are you planning to bring in new bid writers or salespeople to really push those conversion rates up? And then the way that the workings are set out here, again, this may or may not be relevant to your business, is how you might want to break down customers by different types. For example, in this model, we see that there's 3 different types of customers: local authorities, schools, and corporates. By breaking them down by the different types, we can then get to different numbers of those customers. And so that then brings us to one side of the revenue equation, which is number of customers times price paid. And so it allows us to put in different prices for those different customers. And again, we expect to see different prices being either evaluated based on historically an average of what you've managed to sell to local authorities or to schools, or it might be based on a plan for going forwards. For example, you know that you're developing your product and therefore you'll be able to sell it at a higher price. And that brings you out at your revenue stream 1. Now, I'll skip past revenue stream 2 into the cost of sales. So cost of sales are the costs that are directly related to generating that revenue. And so that's why there's two different areas where you can put in how you think about costs for revenue stream 1 versus revenue stream 2. And in this case, we're looking at costs in terms of the number of staff required to deliver that contract. And so you would enter the number of staff in here and their salaries. Remember those on costs that you have to add on. If you have got salaried employees, so national insurance, taxes, and that will bring you out at your cost of sales for that revenue stream. Overhead costs, you can also input here the assumptions around that. And here we have the staff salaries being worked out. So these are staff who aren't directly related to generating that revenue. So this might be your SMT team or other people that sit in the back office. And this is calculated in a similar way with the number of staff and what they're being paid. And then the other costs are, again, should be quite straightforward. These are usually based on your historical assumptions, or they might be based on figures that you might have hold of. For example, if you're planning to rent a new office space or warehouse, you would be able to add that new figure in here. And so on the monthly cash flow sheet, you've got the ability to add seasonality to your revenue stream. For example, some organizations that work in education might see their revenues drop during the summer. And so this allows you to put any seasonality that you experience as a business in here.